Okay, we will continue on with our first panel on market structure, the vision from the exchanges. I have with me Stacey Cunningham. Stacey is president of the New York Stock Exchange Group, of the NYSE Group, which includes the New York Stock Exchange, and has a diverse range of equity and equity options exchanges. Stacey is the 67th president and is the first woman to lead the NYSE Group in its 226-year history. Most recently, Stacey was the COO, where she was responsible for the equity markets and the options markets. And she began her career on the NYSE trading floor, where you served as a specialist. Yeah, but it must have been a fun long time.
It was.
Yeah.
Has anything changed?
Yeah.
And Tom Wittman. Tom is the Executive Vice President of Nasdaq and Global Head of Equities. Tom oversees the global cash equities and equity derivatives business. He's responsible for the management, operations, and strategic direction of Nasdaq's diverse set of global businesses, spanning cash equities, clearing, commodities, derivatives, fixed income, trade management services. He's also the CEO and president of the Nasdaq stock market. Tom and Stacey, we are delighted to have you back at Georgetown. Georgetown and the business school, we've had a long-term partnership with both Nasdaq and the New York Stock Exchange. And at this conference, we've always had presence from both exchanges. So we're absolutely delighted to have you here today. So let me follow up on some of the issues that came up with Chairman Clayton, some of the questions that were posed to him. So I'm going to start off with more big picture issues first, and then we can get into the specifics of current headlines in the news about the exchanges. So let's get back to the question of public companies and the number of public companies, listed companies, declining over time. The chairman pointed out his concerns. Why is this happening? And are you concerned? And why are you concerned?
I can kick it off. First of all, I'd like to say that I agreed so much with what the chairman just went through and all the points that he was making around protecting investors and promoting public markets that are accommodating to small to mid-sized companies. And that gets at the root of your question is why is the number falling? And as the chairman said, and as you highlighted in your question, there are so many reasons, and there are a large number of reasons. And at the same time that there are challenges in being a public company, there's access to private capital. So companies have choices, right? And they can decide, do they want to get into the private markets and continue to stay there where they have a little more flexibility, where they have investors that they know and who they can explain their long-term vision to and have control over that timeline, where so once a company becomes public, that's when you have a little more challenge around short-termism, where the shareholders are looking for those quarterly numbers. And I think it's not just one thing, it's a number of things. Our job, and we are concerned about it, and it is a focus, our job is to try to keep those in balance, right? Making sure the benefits of being a public company and the obligations associated with it are in balance, and making sure that investor protections and corporate flexibility are in balance. Because anytime we're changing things, we might introduce governance. I mean, so much of what was just covered, they're all contributing factors, right? If you look at governance, if you look at the quarterly reporting, if you look at the compliance with regulations, all of those things are contributing factors. And if you introduce something that is new and, well, it makes sense, right? I mean, everybody wants to have investor protections, but when companies have a choice to stay private, those that are left out is the investor. And so, I agree with the chairman that we need to make sure that the retail investor doesn't lose the ability to invest in the most dynamic, exciting, growing companies that are out there.
I agree, and I really love the Nasdaq blue dress you have on today. That's cool. I love that.
It's NYSE, actually, but it's slightly different
Tom,
shade.
last time it was Nasdaq socks that you were wearing. Now you're commenting on the Nasdaq blue. I guess we all matched here.
He's very obsessed with wardrobe. It's always a big focus.
Anything
I
else?
can probably just add a couple points. And I agree with everything that Stacey said. I think the one thing that's most disappointing is that I won't get to see my kids or my grandkids invest in companies like Apple and Amazon if that trend continues. I mean, those companies come out 250 million in market cap, and they just grow, and people get to have the opportunity to do that. And the private equity money is abundant, it's there, but it's to very few, and it's not to the retail investors that have $10,000 or $20,000 in the account and want to invest and watch these companies grow. So that's a disappointing part. With Project Revitalize, that we had a blueprint that we put out along these lines. We're also concerned about the small and mid-sized companies that do come and get out into the public market, and what can we do to help those companies succeed. And a lot of it revolves around liquidity, and we had put a plan forth to revoke UTP and try to consolidate liquidity into those companies. So when they do get there, let's get them liquefied and let the public see a good solid quote and invest in those securities. So I do agree with a lot with what Stacey said about the public markets versus the private markets.
Yeah, I mean, we compete on a lot of things. We're very aligned on these issues, and we're both out there advocating to make sure our public markets are accessible.
And there are companies, I mean, it's, the way the question's worded, it feels negative, and we always look to have more companies go public and get those listings, but you really can't compare it to the .com. So you have to kind of carve that piece of the number of companies that went public back then, but still it's a concern. We want to see more companies go public, not have the lawsuits that come in place when they try to launch, and some of the other things that were expressed.
So, but some would push back and say, well, the small investor is getting access to these companies because now even the Fidelities of the world are investing more and more in private companies. So indirectly, the small investor is getting access. Is that enough in your mind?
I don't think it's enough. One of the things that makes our market so unique is that retail investors have access, and the SEC has done a good job of putting in a framework that allows for capital formation, and it gives them direct access, that they can have a say, and they can choose what they want to be part of. They have options and they have choices, and they can have a diversified portfolio where they're choosing individual stocks, where they're investing in a fund, where they have professionals that are overseeing that. In those cases, there's maybe access to some of those private companies. Or they can use passive investments in the form of ETFs. So they have a lot of choices, but we don't want to reduce their number of choices and just say the others we can decide for them.
Yeah. So related is the issue of governance, and both your exchanges have received a request from large institutional investors, asset managers like BlackRock and CalPERS, CalSTRS, T. Rowe Price, et cetera, about that the exchanges should require companies with different share classes that within 7 years they should get rid of that. Are you going to accept that proposal, or where are you with it?
I think there's been some movement there, right? So that's more of a middle ground proposal. Originally, it was you should just prohibit dual class voting rights, and that's certainly something that we couldn't get behind. I think we are open to discussing these proposals. It's important that the voices of the issuers and the investors are both at the table, as well as others, because this is the same issue, right? We get to that balance, and you want to have investor protections. But we're not just competing NYC to Nasdaq, we're also competing with the private markets. And so the end investor doesn't win if that company just stays private because they want to have control over voting. And you look at some of the dynamic and exciting tech companies out there when they're growing and their founders saying, well, hey, I'm not going to cede control over my company because I want to go public. They can stay private. And so that trade-off, if you don't have that balance right, is that you're going to limit opportunities for investors. And I don't think that's the consequence that we want to see. So we're open to, is there a time frame where those voting rights could sunset, but we want to make sure that the conversation is really thinking about the overall landscape.
Yeah, we support dual class, and we do have some tech companies that did want that. We believe in choice, both for the issuers and I think for the shareholders, of those institutions. If they can't attract the right investors to that type of structure, then that will help them decide the success or not of their other companies too. And they do need to have those choices. And then, of course, the investors, as long as there's enough visibility of what those choices are with the structure of dual class, then the investors, the investing public, can make those decisions. What's magical about 7 years? I don't know. I think you can move that one way or another. We're not, we don't have an axe to grind either way on that, but we like dual class.
I see sort of a slight shift in the position of the exchanges. This issue came up at the conference last year where I think the exchanges were very clearly saying there's full disclosure. Whoever wants to invest can invest, just
That's what
like
Tom
Tom was
just
saying.
said.
But it seems like now you're more willing to listen at the possibility.
Willing to listen if we have the right voices in the conversation. And you know, I largely agree with Tom. I am probably slightly more flexible on is there some middle ground. I do think when you listed, Reena, who are the those that should influence this? Is it the SEC? Is it the index providers? Is it the exchanges? You actually didn't mention investors, and that's an important one. The investors have a vote, right? And so they can say they're voting with their money.
Yep.
So they're voting with their shares, and if they buy shares, and we shouldn't ignore the fact that that's how they can express their support or not in those structures.
Do you have any views on investors are saying index providers should not be in this game?
Yeah, because they want to, you know, you look at some large institutional investors, they feel like, hey, we lose flexibility. You know, if they're competitive with their peers and somebody is investing in a growing company that doesn't have a structure that one firm who's choosing not to reward that with their money has, and they're at a competitive disadvantage now, they don't want to be put in that position. So they're saying, don't let my competitors buy those stocks either. And I don't think that's the right answer, but to limit choices.
So you've been in the exchange world, both of you have been in the exchange world for a very long time, and you've seen lots and lots of changes. And I think we're at that point where huge disruption is happening in this area. What are the major changes if you're looking through your crystal ball and think about your own exchanges? How are your organizations evolving? Where are they likely to be 10 years from today?
I think you have to look, if you look back 100 years and then 20 years and the change, I think what's really driven change is competition, technology, regulation. And maybe not in that order, but technology has really driven the change and created more competition over the last few years. If you think about 20 years ago, how it could be the New York Stock Exchange, not to use Philly, because Nasdaq was a different animal until things got going. But you had floor-based exchanges. An exchange really was just an exchange which traded either equities, and then when options came along, traded those. And it's very difficult to compete in just a one-dimensional kind of game. So if it's just equities or if it's just options, these companies, our companies, we're global companies. We're multi-asset, multiple different geographies. And Nasdaq also has a big tech business that we're growing. And so I think as you go forward, you'll see the change. We saw open outcry, paper trading, floor-based, single exchange, to highly electronic, less people, broader distribution, and you'll see that continue. And I think even as you imagine what's happened in the past few years, you look at quantum computing and cloud computing, that technology will continue to shape the game. But you can't be one-dimensional in this. We're global companies that try to run multiple different models across multiple asset classes and global. And I don't think you'll see that change. You need scale for these businesses, and they're public companies.
Yeah, I agree. And if you look at technology and regulation together, really over the past 10 years have shifted, caused a lot of the changes that are noticed and talked about in the markets. But the markets have been changing and over a much longer period of time. And there are new products that come in and that might be viewed as disrupting products, but we view them as new ways for investors to be able to scale and plan for their futures, right? And save and invest. And when we look at some of the things that have, how technology has improved with competition, the results for investors, it's really, they're the net beneficiary when you look at how they can trade, they can receive prices. We talked about how critical prices are and that price discovery process. They can receive prices for zero to little cost. They can trade in less than a second in a security. They have the option 25 years ago when the first ETF was launched, and SPY started to trade on the New York Stock, NYSE American, or was the American Stock Exchange at the time, market. That was a disruptor, right? Hey, this is a whole new way to invest. And what ETFs have done is introduced a way for investors to have access to asset classes that they didn't necessarily have access to before, and diversified exposure in an easy-to-trade way that they were familiar with in trading stocks. That didn't make the single stock market go away, right? I mean, there's certainly new value that was introduced and a new choice. When I look at how technology has changed our business and our trading floor, I started my career on the trading floor, as you said. I couldn't process the 50 billion messages a day that we process through our systems. So those traders on the floor today are using algorithms to do their trading. So technology has evolved so that they can focus their business, their minds on the parts that are most important for them to have that human judgment and human element, and they can let technology do the more, automate the more mundane tasks.
So 20 years ago, I sort of remember the competition was really New York and Nasdaq. It was very domestic in nature. But now, what about global competition?
Yeah, I mean, there's obviously global competition. I mean, our listings businesses are really kind of, they're global businesses now. We're competing for foreign listings. We've got businesses around the world that trade derivatives and options and fixed income. Our treasury markets, 22-hour market, our commodities businesses. So it is global in nature, highly technical in nature, and like Stacey said, it's really great for the investors. Years ago, you couldn't go onto your online broker account and trade options and equities. You have options, equities, futures, ETFs, options on ETFs. So it's gotten so much better through this, and I think
cheaper,
and a lot cheaper, I remember doing the first equity trade I did was in Novell. So if anyone remembers Novell, it cost me $38 to do the trade, and there were commissions on top of that. I think it was like a $9 stock. So, and it took a couple hours to get the execution report back. I'm sure that it passed through a lot of hands and people looked. And back in the options days, when there was paper, there were 500-600 traders in Dell Computer when it was only listed in the Philadelphia Stock Exchange. And I was being asked to bring faster printers there, to print paper faster, to go into the crowds. And you'd see these guys picking up paper and trying to figure out how to execute these orders. And people still really wanted to trade options in Dell Computer. And it really pressured us to add technology and add competition. And I mean, the individual investor is in such a better place today than they were 10, 15 years ago. I think it's great.
Okay. So let's move into some current issues that have been in the headlines recently. And I'll have to start with issues around fee. And let me this quote from Chairman Clayton said that businesses have emotionally held views about the cost of market data. If you want to appeal to me, explain to me why what you want is in the interest of people who are in the market for the long term.
I think that's the right question. And I think if you look at the debate around market data and the fact that the cost of data is rising, it is not surprising. The value of data and access to our markets is changed so much given the competition that's been introduced in the market and given the value that data provides in today's world. When I look at how, it's not just specific to financial markets, it's everywhere. I look at how I use my phone, and 10 years ago, I used my phone to make phone calls and, maybe some text messages. And now I'm using it to adjust the heat in my home, to trade online, to research stuff on the internet. You can do so much with that power. And so that's really changed the way I operate, and it's changed the way businesses have operated here in the US. So those broker-dealers that are now using the data that they get from the exchanges about prices have been able to build new businesses around that data, and it's brought down their overall costs because they can, they automated a lot of functions internally in their own businesses, and they've introduced new business lines, and it's reduced the overall cost. Now, the argument that often gets made is the cost of data gets passed back to the end investor. The all-in cost gets passed back. So when you're talking about just that cost of data being passed back and ignoring all of the savings and all of the new value that is introduced by that, you're misleading people to say, hey, that's a cost that's getting passed back. It's actually a benefit. And if you look at the data, investors have it better. It is a benefit that's been passed back to them.
And it's, that's out of last week's meetings, there's a lot that I could talk about because I didn't get to say a lot on the panel, I don't think. But
no, I think we had the quietest.
But it's, it isn't. The data in general is very interesting. I mean, even the Amazons, the Yahoo, Facebook, data to them is very important. So they provide a service that you like. You go onto Amazon, you order something, it's right there. Stacey talked about using a phone. I mean, it almost has taken the place of a desktop. I mean, if I want to go to YouTube and figure out how to fix my lawnmower, I'm there using that, and it's great. But I think, the other question about data and the cost of data, if you take a look at the entire institution of an exchange and the markets that we run and how we run them and being Reg SCI compliant and having backups and uptime and the investment we make in hardening those, creating more functions and features is, there's a lot there. And I think at the end, if you go ask an individual investor about the cost of data, they don't see a cost of data to themselves. If they see $5.99 to trade or free to trade, that's what they see, and they see great quality quotes, fast executions.
So why is it so difficult to convince the public or the regulators about your story?
I think there are a lot of misperceptions. Like, I hear terms like public and private data, and it's maddening because I don't know there's nothing private about the data that comes out of a Nasdaq exchange. It is data that is available to anybody that wants to subscribe to it. And an end retail investor is going to have a different need for the data they consume because they're not market makers with hundreds of millions of dollars of capital at risk every day, providing liquidity to the marketplace so retail investors can trade. And also, by the way, so those firms can trade against that order flow and make money too. But there's a way different, and I was trying to think of an analogy to use on why those market makers need a different size pipe to receive the data because they're sending a lot of information in and out. And they also need a different view of the data because they're managing risk across 13 exchanges and 40 different dark pools. And it doesn't take much to get, run over for their liquidity. So the only one I could think of on the way down as I was late is, for example, there could be lawn service. You think about lawn service and the type of lawnmowers they use big industrial lawnmowers to try to get through properties, mow them, and it's not really something that someone needs for a third of an acre. But if you want to buy that lawnmower, you can go buy that lawnmower to do the job you need to do. Not a very good analogy, but
no, I think it's pretty good. It's okay. I think the issue and the reason why we can't get the point across is because there are vested interests in those that are lobbying and making these points, right? And so, the reason why I think it was the right question from the chairman is it about Main Street or is it about Wall Street? And this is a fight that's about Wall Street because the costs of data have gone up in connectivity because it wasn't a competitive landscape. When I was on the floor of the New York Stock Exchange, 20-something years ago, if you were there, you didn't need to go subscribe to a bunch of data feeds because you were just there. 85% of the trading was happening there. You were going to be protected. Now, markets, the banks and the broker dealers and market makers are stitching the market back together because trading is happening on 13 different exchanges and 50 different dark pools. So they're stitching that back together. So that's a new thing for them that they're paying for that, and they look and say, well, hey, can I reduce that cost? Their costs have been reduced elsewhere, though. So I think that all-in cost is really important, and people are focusing on just one piece of it. And there are some out there that are lobbying the SEC, and we should be lobbying the SEC for things that are good for the investors and issuers, and making sure that our markets are accessible to them, not for our own interests. I do not believe that any market structure reforms should be based on the needs of intermediaries. I think we should be thinking about, is this good for an investor or is this good for an issuer? The intermediaries, which the exchanges I would consider, the broker-dealers, market makers, we're going to change our business models to work in whatever framework is there. The framework should be benefiting investors. And so it's surprising to see this debate be pushed to the SEC to have them introduce some sort of price controls around the competitive landscape. And there is a lot of misinformation out there. We operate 5 equity exchanges. Some members are members of, some of our members are not members of all 5. So there is choice. You often hear the argument that people are forced to connect to all the different venues and that people are forced to subscribe to all the different data feeds. That's not true, right? So when we look at our member base, they're not connected to all. They're not necessarily members of all 5. Some of our members that are members of multiple exchanges don't necessarily take the proprietary data feeds that don't have the same footprint. So I might have one member that takes the prop feed from NYSE and doesn't take it on NYSE National. it's actually free on NYSE National, so it's not just about money. Like, there is a competitive landscape here, but they're looking at their expenses and thinking, hey, if I can lobby the SEC to reduce this cost, I'm gonna be a net winner. I don't think that's where we should focus our energy. Focus our energy on getting companies to come public so that we can invest and trade them.
Yeah, so just to put a finer point on a couple of points you made, I think it is, if you look at these trading firms, their personnel who used to sit out on the desk and trade, those numbers have gone down drastically, but their volumes really haven't gone down. It's been displaced with electronics and computers. So that's, but that's what they look at. The other thing I think is there are a lot of firms, the wholesalers, that internalize order flow and are trading a little bit less on exchange and more off exchange. And these are all dynamics that are easy to take a real small point and say, I think I'm paying more for the data from the exchanges. And a point that I made last week is we compete with our biggest customers. They're our biggest competitors. Stacey in New York's a big competitor in a lot of ways. These guys they're great customers, but they're competitors. They internalize order flow off exchange, and they print that through trade reporting facilities, which we run one, and then we give to the biggest consumer or biggest producers of that, we give them 98% of that tape revenue back, which is kind of like, it's hard to believe that we're sharing that tape revenue with them when they're taking that much order flow off exchange. And I know if you take a look at the 40% that trades off exchange, half of it's probably institutional block type trading and the rest is retail. And I bet that most people who enter orders to an Ameritrade, E-Trade, any kind of broker-dealer system don't realize that most of their orders do not execute on one of our exchanges. They execute off exchange. But those same facilities are using the price discovery mechanisms that are produced from the exchanges themselves. We're collecting all the best bids and offers, disseminating that for public use. They're using that to internalize order flow. So it's kind of it's a very strange kind of dynamic and relationship that we have with our customers/competitors.
I think that's really important because the prices are being set in the lit markets. And so that's why we focus on making sure we're not hurting that price discovery process. And so when people are displaying their prices in the lit market, they're taking a little bit more risk. They're showing their hand, right? And they're saying, this is where I'm willing to trade. And those trading in dark pools are taking a little bit less risk because they're not advertising their interest. And so that dynamic it's fine. It's especially fine in a low volatility environment because once markets start moving, though, that risk profile of holding your hand up costs you more money. And so there are a couple of ways to address that. One, we incentivize people to take that risk by paying them now. We didn't used to have to do that because it was a more diverse ecosystem of business, and they were trading against retail investors and trading against institutional investors, and now a lot of that trading is happening elsewhere. And they're just sort of waiting for the price to change, and that's a riskier place to be. And so I think it's important when we look at things like the SEC has been proposing, like the access fee pilot or transaction fee pilot, which would reduce those costs and reduce the ability for us to compensate market makers and any investor for taking risk and raising their hand. We get concerned on what the end result is for the end investor. Spreads will widen. I've heard plenty of times from professional market participants, whether banks or even some of the large institutions, saying, well, it's okay if spreads widen out, that's fine. And that's because they don't have to pay for that, because that goes back to the end client. And if you look at the shift, you keep hearing, well, exchanges became for-profit companies and now they're just selling market data and colocation, is an argument I hear a lot. Exchanges were owned by the broker-dealers before, and so that's something that is, those profits went back to them. It was owned by their members and those profits went back to them. And now those profits are going back to the public shareholders.
So I have to make two more points. One on discriminatory practices between ATSs and lit exchanges. I can't deny anybody access to our platforms. Any member wants to come in, we let them in. And we don't discriminate in pricing where all the firms that come in, based on a fee schedule, we get paid a rebate. And I can't choose to trade, or I can't have my market makers choose to trade with one set of members and not another set of members. And also can't have price improvement at a certain level for this member versus that member. So which is a very different competitive landscape, which puts us at a bit of a disadvantage. Talking about rebates just for a second, Interactive Brokers switched from Nasdaq to IEX. And I think, and this could illustrate the fact that market makers aren't being paid a rebate to tighten markets there. The average spread in that stock before it left Nasdaq was 5 cents, and now it's 9 cents. And so if you don't think that's costing investors money, that's costing investors real money. And the second point is if you look at the closing cross and the deviation of the closing price compared to a volume-weighted average price up to the point, Nasdaq had a 1 cent range for 30-some days. And Census Switch has had a 17-cent range. Now, if you don't think those two things cost investors money, it costs investors real money.
Yeah, I mean, the spreads widened, the displayed size went down, and volumes dropped. I mean, and pretty much on every metric, it's a worse experience. And, you know, I think you often hear it get described as, you know, because we're in other businesses and selling stuff. And when you look at, you know, you look at buying a car, and you sell car mats, and you sell, you know, snow tires or whatever that might be, and you charge separately for those things, but your all-in cost to buy the car is still cheaper than if you pay one price for the entire thing and it comes with new snow tires and it comes with floor mats. Why are we complaining about the price of the floor mats? Like, it's still cheaper. And when you look at our cost, it's cheaper to trade on our exchange, including market data, including connectivity, including membership fees, including, you know, all of the co-location and everything else. The all-in cost to trade is cheaper than it is to trade on IEX, but yet they claim we're not doing the right thing.
I assume market participants will realize that very quickly, and they'll go wherever the all-in cost is cheaper, rather than looking at the separate pieces.
It depends on how BestX is defined, though. You know, there probably needs to be, you know, a little bit reworked and redefined, because that wouldn't be the case, right? It's got to be, you know, the NBBO, but there's probably, like you said, there could be more to the all-in costs.
Okay, moving to consolidated audit trail. So the SEC has declined your request for an extension to launch the consolidated audit trail. So what's the game plan?
So we're coming up on a November 15th date where we plan to be reporting to the Consolidated Audit Trail. And the Consolidated Audit Trail was really born out of the 2010 flash crash, right? So the SEC wanted to have more visibility and be able to more quickly determine what happened. Mm-hmm. And they wanted to have a repository of data industry-wide, kind of across all the different exchanges and venues. That's a noble cause, but as we've talked about, securing data is really important. So when we are undertaking that, the initial plan was collecting the PII, or personally identifiable information, for each individual investor. We fought against that for a while because we didn't think that was a good risk-reward trade-off, right? To have your social security numbers in a database that we know is going to be at cyber risk. So there were a lot of delays in trying to make sure that the data was going to be secure, scaling back some components of that, and frankly, we are behind schedule, you know, by about a year. But November 15th is when the exchanges start reporting.
So there was a group of us that met with the chair. It seems like it was about a year ago, and you know, we knew that the date was in jeopardy, and it could be as long as a year to get it done. It's a very complicated project. There is a tremendous amount of data, and if you look at the data that's come out of the exchanges, especially the options exchanges, the past 30 days, it's immense. You know, 35 billion quotes on a given day. So the challenges will become greater than even what they're dealing with today. Out of that meeting, one of the things that I committed to that group is that we would take who we thought was our best project manager and lend it to the group to try to help drive deliverables. And so, you know, we've done that. I think it's been helpful. I'm told on my way down that, you know, the date's still the date. We're still driving to get to the November date. They're still testing. I know there's, you know, customers have called me, and, you know, they're concerned about the amount of time that they have as part of the testing to get there, and testing is an important thing. So I think we'll get there. I think the problem will be it's gonna be an iterative process. I think there's still some issues with some options data that we're trying to figure out together, and it'll be a work in progress for sure.
So the chairman talked about how in his confirmation proceedings, cryptocurrencies didn't come up, ICOs didn't come up. And suddenly, in the last year and a half, there's a lot more conversation about that. Are your exchanges, your organizations doing something with blockchain? What are your plans? And how do you think about the whole fintech, ICOs? What does that mean for your organizations?
So I'll take a shot first. So there's, I think, a conflation of terms with ICOs and blockchain and crypto in general. And I think it's going to take some work, and I know the commission's looking at it, and you know, we've had meetings and talking about what does it mean for an ICO, and it's got to be something that where there's extreme clarity for an end investor to understand what that is. So I think we're a ways away from securitizing and having SEC blessing on any kind of ICO. That's my opinion and Nasdaq's opinion. Now,
although when you meet with people, they always say, I have the SEC compliant solution, and we have it. It's always funny to me that people seem to claim it's, you know, complies with all the regulations that are out there. I'm like, really? Because the SEC actually hasn't put in regulations yet.
Yeah, not in line with what what we need to do for listing securities. Right. So you have that, but blockchain is, you know, a piece of technology that we're working within Nasdaq. It's not a piece of technology that we're going to be putting into our options and Nasdaq equity markets within the mainstream matching engine. But we are using it in a big way to enable our tech customers through our Nasdaq Financial Framework and putting adapters on that they can use any one of the blockchain enablers as well as any cloud companies. So those together we're using in our Nasdaq Financial Framework to enable tech partners. And as it relates to crypto itself, we've actually been a little bit more active in selling surveillance systems to crypto exchanges. And I always have a hard time saying crypto exchange because an exchange, these are exchanges, and the crypto exchanges are a little bit different when you look at them. Less regulated, less complex.
It's interesting how some really large valuations are being put up on the crypto exchanges.
Well, there's probably a lot of people here that have invested in crypto. It's not a cheap endeavor, and price discovery, price transparency is very different, and try to get in and out of them. Like last year, whenever there's volatility, it's not an easy proposition. Which is one thing, you know, that the U.S. stock markets, as Chair Clayton said, they are extremely effective in what we do with price discovery, price dissemination, and allowing the public to do that. That's not the same in the crypto world, and I'm sure that, like I said, there's probably a lot of people in the audience that have actually traded that. So we're selling technology. We've got, if we launch something, it'll be on our futures platform in the form of future, and we do have some partners that we're working with, and you know, when we get closer to be able to announce something, we will.
We announced in August a partnership. We teamed up with BCG, Microsoft, and Starbucks and formed a company called Bakkt. And Bakkt is a company that will enable consumers to buy, sell, spend, and store digital assets. So that's one of the things that we've been very focused on, and how can we solve some of the problems that exist in the cryptocurrency space today. And if you look at the two main issues that often come up, one is the risk of nefarious actors not being, not having appropriate oversight, and two, the risk of cyber theft of the assets themselves. So what Bakkt aims to do is introduce institutional grade protections to address both of those issues in warehousing, making sure it's secure offline, and also to have AML, advanced AML and KYC. So it gets us to a place that is a little bit more like what we have today and the framework that we have today, which I think is an easier step forward for the regulators to adopt the appropriate regulatory framework. When we launch it, we plan to launch with a single day physically delivered Bitcoin future. And so that is pending CFTC approval, of course, but that's what our phase one is.
As someone who's done quite a lot of work on IPOs way back, we're starting to do work at Georgetown on ICOs, and the whole disclosure issue is a completely different ballgame. You start looking at analysts who follow these ICOs, completely different from what we're used to typically thinking about. But it's some of the issues that we are studying here at Georgetown and trying to make a sense out of that. Okay. Lastly, let me ask you sort of what I asked Chair Clayton. If there were one or two major regulatory changes that you would like to see, what would they be?
I think it's thematic. We spent a lot of time down in DC talking about market data and connectivity, and I think the issues is how do we get more companies public? And so, I think if we look at focusing our attention in DC on the places that the chairman was saying he has his attention focused. We want to make sure that's actually what's happening, and you know, that's something that I think is important. And when, from a regulatory standpoint, you know, I would be concerned to see the transaction fee pilot adopted in its current form.
Yeah, I think it's hard to think about such a big question when I get marred in the details,
Yeah.
like what Stacey said on, like, why are we spending all this time? We had MSAC and we did, you know, this access fee pilot, and then the solution to that is let's just throw this big blanket access fee pilot across the board and pick these arbitrary numbers. And it's just, for me, it's just, it does not compute. And we're spending all this time. We saw that a tick pilot really didn't work. And now we're taking this, like, just throw this, you know, one size fits all big blanket across access fee pilot, and then we're trying to defend, in my mind, some things like private and public data feed. Okay, now I've got to go down and talk to, you know, a bunch of people about this terminology, which is, it's a lie. It's not true. It's got this connotation which just isn't true. So then going down, spending time doing that. So I know it's not a good answer to your question. It's just...
It's just more that there are some regulations that we want to see not happen,
Yeah.
because we don't want to take our position for granted. You know, we shouldn't assume that we talked a lot about the position of strength that the U.S. is in global markets. That doesn't guarantee that we're always going to have that. So we want to make sure that we're protecting that, and making unnecessary changes that might put it at risk is the most concerning part, which is why I think we both kind of went to the let's not do that. But you did ask the commissioner another question that I would love to answer if given the opportunity. It was about the students and the financial markets.
Yeah,
and
I was gonna ask you that, actually.
Oh, good, because
So
I
please, go
have
ahead.
really strong feelings about this. And I think the financial markets are often viewed as a negative thing, and it's about them making the rich richer. And you know, what Tom's company does, what my company does, and what the banks are doing, and is providing a framework that allows companies to raise money so that they can go out and change the world and scale their products and services and make them available to the masses and not just the few with means. That's what makes this country really unique, and it's really what it's been built on. So if we go back 225 years, that's what was happening, right? And Alexander Hamilton literally hatched a plan to create a financial framework, and you know, I think that there's a lot of value in providing that service so that we're not limiting opportunities to just a handful, and we're making it scalable to so many. I think that's a noble cause, and so I don't think people should view it as a negative industry. We probably haven't done a good job of marketing ourselves in a positive light.
It's, you know, it's interesting you say it made me think about a dinner that I had with 15 listed companies in Philly a couple of weeks ago. And there's a listed company that's got, you know, what they think is the beginning of a cure for MS. And it's really special.
And it's really both the issuers, what they're doing, the listed companies, and the opportunity for investors, whether it's your retirement. And so I try to tell our students that really Wall Street and the financial sector, if that's not operating properly, Main Street couldn't be operating. You couldn't pay the salary check to an employee if you didn't have the financial structure operating. You couldn't do all the good in the world if you didn't have the financial structure in place and operating properly.
But a lot of people think that they're not in the financial markets, or that they're not close to the financial markets, and they're probably wrong. So if you have a 401k and you're out and working, you're in the financial markets. Even if you're not directly investing yourself, when I look at what our listed companies are able to do, and when they scale their businesses and they raise money, they can create more jobs. And just the companies that are listed on the New York Stock Exchange employ 45 million people. So when you're part of a process that enables them to grow and raise money, and you know, you're facilitating that work, you're creating jobs around the world, and then they can go cure MS. You know, I mean, it's really not painted in a positive light when people are saying that they're not doing good work.
Yeah, it's really cool. And there's, you know, from financial to tech, there's so much you can do in the space. So it's, for me, it was tech, so it's been, I love the space.
Yeah, me too.
Yeah, I think we just need to get out the story more and help people understand, especially the young people, help them understand that a little bit more. After the financial crisis, there's sort of this perception, I think it's changing again now, but that finance is all about greediness. Right? Okay, with that, let's open it up to questions. We have 2 mics on either side. Please feel free to come up, and if you can introduce yourself briefly, and if you keep the questions brief, we can get a lot more covered.
Thank you. Thanks for your presentation. My name is Li Yang. We all know, and you all talk about the data and analysis and how the market of stock exchange work, and maybe even a pension, everything. But the problem now, the system works against the individuals. Because the individual, let's say the margin has been traded by other people other than the shareholders. What I mean, some fraud and crime operation. So it's the mechanism that really work for the private shareholders or the stockholders, so they can really get back to their ownership rather than being the victim of just fraud and crime, and then you cannot be them because they are supported by law enforcement and officials, and they work together. So it really means we need a mechanism with the stock exchange or corporation or some kind of civil rights commission. We have to work together, fight against the DOJ or FBI and so on.
I think there are a lot of we do spend a lot of time on making sure there are investor protections in place so that investors have some security. And I'm not sure if there's a specific scenario where you feel like there's risk to investors, but I do think that our public markets do provide a framework that helps to protect investors.
And a question here.
Yes, thank you very much. My name is Tom Luby. The name of my company is Populist Markets. And looking at the fixed income markets, there is such a strong contrast between the lit equity markets and the OTC market model, which has been used in fixed income forever. What we're seeing now with the increasing growth of fixed income ETFs is really kind of a migration of assets, investors voting with their feet, if you will, out of the cash markets into fixed income ETFs, largely because of tradability and liquidity issues. We know that the ETF arbitrage feature, the creation redemption process, will always necessitate the use of the cash markets to facilitate the creation of fixed income ETFs. Does the thinness of the cash market in fixed income worry you? Is that going to be a constraining factor? And maybe an ancillary question to that is, do you think that this will augur for the actual listing of fixed income instruments on lit markets?
I'll try from the Treasury side, just because we have a platform, the old eSpeed platform, which trades, on the run Treasuries, and that is that, and then you can go to muni bonds too and talk about the lack of visibility of markets. But in the U.S. Treasury market, they are getting less and less liquid and more fragmented from the couple of years that I've been involved with it. So I think that part of it is a valid concern. And I think we have seen a big uptick in the ETFs that revolve around those type of products. And there's probably it's one that's more available to retail investors. Retail investors have don't go in and trade the 2, 5, 7, 10, 30-year on-the-run treasuries. But it is getting less liquid, it is getting more fragmented, and it's a market model that's starting to move towards bilateral streaming between market makers and banks. So that is, I think, beginning to create that phenomenon. But
we have a history. So the NYC Group is owned by Intercontinental Exchange, and our history is to go in and make markets more efficient, and introduce new technology that does that. So within the fixed income space, we're doing it in a number of different ways. One of them is we announced a facility that would make the fixed income create redeem process more efficient. But at the same time, we're also looking to make the underlying trading of those products more efficient. So like we've done in other asset classes where we started with trading platforms, then introduced data that could provide visibility into those platforms, helping to make them more efficient. We're doing the reverse in the fixed income space. So we have already had a robust data platform through the acquisition of Interactive Data Corp. And we have a lot of fixed income pricing, continuous pricing on bonds. And then layering on top of that, we've made a number of acquisitions over the past year of trading platforms. So we can do the reverse to make trading of fixed income products more efficient.
Yes.
Hey, you doing? Steve Cohen from Velocity Ledger. I guess, Stacey, this is more a question for you. Tom, I know what you guys are doing at Nasdaq, but in terms of tokenization and issuance, you talked a little bit about what you're doing with Bakkt in phase one. Do you have any plans, obviously, because tokenization solves a problem in the microcap in terms of raising money? What is NYSE doing, in terms of your phase two, your phase three with Bakkt? Is that something you're planning on doing? I mean, ICOs are hot and all that stuff, but really structurally, from a regulatory perspective, Bakkt is probably your first step into that. What are your plans in terms of augmenting your issuance
I
business?
certainly think you can't ignore that trend, that there's a lot of interest there. So we spend a lot of time talking to different participants in the space and looking at potential solutions that could exist. So without getting into too much detail, we spend the energy on it because this is definitely, there's interest. We're not there yet from a regulatory framework to say, hey, we're going to start launching ICOs and listing and trading ICOs, because we think that there still needs to be some questions answered. But we spend time on it.
But you're not looking at it like, oh, this is the latest shiny object and everybody's got to look at it. I mean, there's a trend towards it.
No, but you need to make sure you know what the shiny object is, right? And that
Right.
you're spending, you can't ignore it. So, you're not going to see us announce that we're listing an ICO next week, but we're not ignoring it.
Appreciate it. Thank you.
Hi, Kelvin To at Data Border Technologies. First of all, I want to applaud the SEC for hosting the market data and access roundtable last week. But also aware that, like Stacey, you wrote a piece about how maybe disappointed to a point that missed the opportunity, which I come across on tech forums. I'm not on either side of the fence, but I do understand M&S does make the exchange more competitive, or trading venue did become more competitive, and you folks may have to leverage on the economy of scope so you can go into those data and technology business, those type of things. But how do you refocus back on economy of scales so that exchange can become more competitive with private equities, so that small companies would be able to benefit from being public? Because I come across working for large financial technology companies myself, and they got tons and tons of cash available. They are listed on exchange, and they are using those low funding costs to buy up smaller company. And smaller company, well, they rather sell to those larger companies than really go list it themselves and be a competitor to those larger players, larger incumbents. What's your takes on that?
Well, that's exactly why I said I was disappointed that, we spent 2 days down in DC and we were happy to participate, and we came in constructively and we came in with ideas. But that's the bigger problem we should have been spending all the energy on, is how do we encourage small companies to be able to come list in the markets? I want to be able to compete with Nasdaq for listings because I want them to be coming, and if they're not coming to the market and we're fighting about market data, then I think we're fighting about the wrong things. So, when you look at the cost of being a public company, that's one of the challenges, and it's easier to be acquired, or it's easier to wait until you're big and you can build a whole team to deal with disclosures that you need to make and to file your 10Ks and to handle the components of Sarbanes-Oxley that you need to comply with. So that's what I think we need to have the SEC work with us on, making sure we have right balance. We have a listed company that publishes monthly, unaudited numbers. They were frustrated by the results at quarterly and investor reactions, that short-term view. I think it's a really interesting path that they took. So it's a streamed down. It's not full earnings. They're not filing the complete details, but they're giving you, hey, here are our key economic metrics, and we publish them monthly. Being creative about how can we change the short-term view that investors have because they're so pinned to quarterly reporting is another. I mean, I spoke with a CEO just 2 weeks ago who said, I have a long-term strategy. They're not yet public. And said, I have a long-term strategy, and I know I'm going to have a couple of rough quarters before we can get it in place. I need to wait to be public until after that. I think that's the wrong
bad,
message for us to be creating in our framework.
Monthly earnings, you ready for that?
It's not earnings. It's just
Yeah,
hey,
I know.
here's the, and
Here's
it's
the metrics,
actually an
yeah.
interesting thing. It's hey, here's the metrics that you guys care about. It's unaudited. It's not a full 10K,
Yeah.
but perhaps we're not going to, it's one side of the debate. We talk about guidance. We talk about quarterly reporting. Yeah. Maybe there's something simpler we can do that's not so expensive to do.
Please join me in thanking Stacey and Tom for this great conversation.